time, though, our next guest, Abhey Lamba, is a technology analyst at the ISI Group. He recently published a note comparing Apple to Disney, illustrating that despite leadership changes at Disney in the 1960s when Walt Disney passed away and Roy Disney took over, the stock continued to flourish in the years following. Now, Lamba expects the same for Apple. For more from Lamba, who, by the way, has a buy recommendation on Apple stock, he joins us now. Dominic and John in on this conversation. But before we get to what it means when we see CEOs change hands and CEOs that are so affiliated with their companies. First off, on Apple, they have so much cash. You do expect a dividend at some point from this company, right?
Yeah, we do. We think over the next 12 to 18 months, we should see a dividend as well as a buyback from them. Up until now, investors have been asking for it, but they were patient because Steve Jobs was in control and they wanted to give him a free rein in terms of what he wanted to do with the cash. With him kind of stepping down from the CEO role, we think that should kind of go louder.
Well, Abhey, is that a sign, though, that Apple's days, I mean, yes, we can see the stock climb like it did for Disney, like you say in your note, but does that mean that they have nothing better to do with their cash than to give it back to shareholders in buybacks or dividends? Or does that mean innovation continues and we might see more R&D investment?
It's going to be a little bit of both. If you look at it, they are generating about $30 to $35 billion in free cash flow. So even if they were to do buybacks and give dividends, they would still be left with extra free cash flow on a going forward basis. And they already have $76 billion on the balance sheet. That's about $80 a share. So it's not that they don't have enough projects to invest in. They do. But they're still generating a lot of cash that they can disperse back to the shareholders.
How much of a buyback and how much of a dividend?
It really depends what they do. We saw Intel has a 4% dividend yield. If they do that much 4% dividend yield, they can give out about $15 a share in dividend and still have about $25 or so billion left in their free cash flows.
Okay.
They may not start at that point.
You mean 25 out of the 76 billion that they've got?
No, 25 out of what they're going to generate over the subsequent years in future.
Okay.
So it's, but they may not start there. They'll probably start at, where a lot of other companies are, around 1% to 2% dividend yield, and then move it up higher.
It's pretty incredible that 10 years ago, 1,000 shares of Apple would cost you about $10,000. Today, it's almost $400,000.
Staggering.
But we're talking today about the economy, the European economy, what that means for the global economy. And you talk about Disney. Disney is a company that's in for potentially some tough times if we see a double dip or the economies around the world slow down.
Yeah.
Apple is not immune to that, is it not?
The thing with Apple is, number one, we compared Apple to Disney, not Disney of today, Disney way back in the late 60s.
Sure.
So that's a different kind of comparison. But coming to Apple, the thing with Apple is that its ability to sell is not limited by the demand out there. It's limited by how much they can produce, how many devices they can, off iPad they can produce, or how many iPhones they're producing and distributing in different countries.
That's a problem every CEO wants, right?
Exactly.
To not be able to sell enough product.
Exactly. So for them, it's about production. It's about producing enough. It's not about end user demand.
But they've got enough in their pipeline that you say can carry momentum for how long?
For the next 2 to 3 years, for sure.
Okay.
And after that, it'll depend on the new products that the new team will come out with.
Just quickly, because I know you did, as you say in your report, compared Apple to the Disney in the 1960s, and we know that the stock went up quite a bit, after Walt Disney passed away. So, what do you take from that in terms of what Apple should make sure that they make sure they do in executing, as Steve Jobs steps away more and more from the company?
Yeah, I think there are two things. Steve Jobs is known for his vision for new products. Tim Cook is known for his execution and making sure everything gets done really well. And I think we don't expect them to miss a beat on the execution side. And they need to prove their ability to kind of innovate and come up with new products. But at the same time, on the execution side, we think next year's earnings, which is currently about $32, could very well be $40 by the time we are in another 6 to 9 months. And that $40 should move the stock and estimates high.
Well, one man in Steve Jobs who's very close to both Apple and to Disney because, chairman of Apple and also the biggest shareholder in Disney. How much do you think Jobs' influence will go into both companies as either the largest shareholder or a member or a chair of the board?
See, lately he was very involved with Apple. He was involved in almost all of the decisions that were happening at Apple in terms of products. And it really depends right now, being chairman, how involved he's staying or how much he's pulling back. Seems like he's pulling back quite a bit. And the existing pipeline should kind of take them for the next 2 to 3 years. It's only beyond that we'll have to see. The new team will have to deliver.
Okay. Abhey, thank you very much.